Good morning. This is Allison Pena with Worldwide ERC. Thanks to everyone for connecting and welcome to today's webinar program, 2021 Changes to the U.S. Mortgage Industry and the Impact on Mobility, sponsored by Serva Mortgage. Please take a moment to review Worldwide ERC's webinar disclaimer before we begin. During the presentation, all participants will be in a listen-only mode. If you have a question during the presentation, you may submit it online at any time. To submit your question, please use the Q&A button located in the lower menu bar. Simply click on the button and type your question into the pop-up window when it comes up. All questions selected will be answered publicly. An email containing a link to the course evaluation and information on accessing the handout and recording of this session will go out tomorrow about 24 hours after the webinar start time. During this webinar, we will be polling the audience. When a poll is opened, it will appear in a pop-up window in the middle of your screen. Simply review the question and submit your answer. The results will display in the same pop-up window once the poll is closed. This webinar is worth 1 CRP and 1 GMS credit. If you are a GMS seeking CE credit for this webinar, you must include the name and date of this event on your GMS renewal application at the time you apply for recertification. The renewal application is available online. If you hold your CRP designation, credit will be added to your record internally within about 10 days. Attendees must be individually registered and logged in for the majority of the event to receive credit. The archived webinar session will be available to all for the next month and available to Worldwide ERC members for a second month. After 2 months, our learning platform subscribers can continue to view this session for up to 2 years. CRPs who log in and view the archived session will also receive continuing education credit automatically upon completion of the session. Credit processing fees for webinars are no longer collected. And now it is my pleasure to introduce today's presenters. Cheryl Pfaffenberger, CRP, serves as Director of Client Services for Serva Mortgage. Cheryl manages a diverse portfolio of clients working to provide value-added options and solutions to their mobility mortgage programs. Cheryl joined Serva Mortgage in May 2006 as a closing coordinator and was promoted to loan closer in 2009. In 2011, she was promoted to corporate loan specialist, where she was responsible for managing the corporate loan program. In 2017, she was promoted to closing team lead, where she managed the closing team and was responsible for coaching, developing, and achievement of department goals. She became director in 2018. Ernest Phillips, CRP, joined Serva Mortgage in 2002 as a mortgage consultant, where he counseled transferees on various loan products for mortgage pre-approval. He currently serves as manager of loan production. Ernie coaches and leads the mortgage consultant team, who is responsible for gathering pertinent loan application data and building customer relationships. He applies technical knowledge of the mortgage industry to train and aid his team so they can provide the best customer service when they assist borrowers in making sophisticated loan decisions. Ernie remains licensed as a mortgage consultant, staying up to date with mortgage licensing rules and regulations to effectively guide his team. I am happy to welcome Cheryl and Ernie to the program. I will now turn things over to Cheryl.
Great, thank you, Allison. Good morning, everyone. It's great to be here today. Quick thanks to Worldwide ERC for the opportunity to share this information today. And thank you to everyone who has joined this call. As Allison mentioned, my name is Cheryl Pfaffenberger. I am Director of Client Services for Serva Mortgage, and here with me today is Ernie Phillips, Manager of Loan Production for Serva Mortgage. So today we're going to cover the topics you see here. We'll start with some recent changes and updates within the mortgage industry and how those changes may impact relocating employees. We'll talk about some current market trends with a little bit of background about how we got here. And then we'll go into some detail about what it's like to purchase in this current market and some of the unique challenges that today's buyers are facing. We'll demonstrate the impact that changes in mortgage interest rates have on affordability. And then we'll highlight some of the things that we are keeping an eye on that may impact the industry going forward. And then, of course, we will take some questions at the end. So let's get started with some recent industry updates. So the first item we have here is the change to the conforming loan limit. Now, the conforming loan limit is set by the Federal Housing Finance Agency, and it's reviewed annually and updated as needed to reflect the change in the average US home price. This new loan limit was effective in January of this year. Now, for those who aren't familiar, quickly, the conforming loan limit is the maximum loan amount that can be purchased by Fannie Mae and Freddie Mac. Any loan amount that's higher than this is considered a jumbo loan. So this is good news for buyers. Previously, the conforming loan limit was $510,400, but now because of the increase, it means that employees can borrow an additional $37,000 without requiring a jumbo loan. And that's good because jumbo loans are typically more difficult to qualify for and require more documentation than a conforming loan. Now, this conforming loan limit is different for high cost areas. An area is considered to be high cost if 115% of the local median home value exceeds that conforming loan limit. So think New York City, Washington, D.C., San Francisco Bay Area. Those are all high cost areas. So in those locations, the loan amount can actually go up to $822,375 and still be considered a conforming loan amount. So the next change you see here is the new URLA, which stands for Uniform Residential Loan Application. So this is a standard loan application form that's used by all lenders for all loan types. Lenders were required to start using this new form beginning March 1st. So the purpose of redesigning the form was to assist lenders in collecting relevant information, but also to improve the borrower's experience and be more consumer friendly. So the new form has an updated layout to improve usability. It's digital, it's dynamic, and it has just an overall cleaner look and feel to it. Now, one significant change that I want to point out is the addition of an unmarried addendum. So this is now standard as part of the new loan application and is required anytime an applicant indicates that they are unmarried. In the past, there were certain states that already required this information on, a civil union or domestic partnership addendum, but now it's standard for everyone. And the purpose of that addendum is to discover if there's any other person in the household that has legal rights to the property similar to that of a spouse. Another change we're pointing out here is the transition from the LIBOR index to SOFR. So a little bit of background quickly. We'll start with LIBOR. LIBOR stands for London Interbank Offered Rate. This was the index used for setting interest rates on adjustable rate mortgage loans, as well as some other consumer financial products like credit cards or student loans. LIBOR was based on estimates from a group of global panel banks who were surveyed and not actual transactions. So what happened was after the financial crisis in 2008, it was discovered that some of these banks were manipulating the market by inflating or deflating their interbank rates. So as a result, the reputation of LIBOR was ruined. SOFR stands for Secured Overnight Financing Rate, and this is the index that was selected to replace LIBOR. Now, SOFR is based on actual market transactions in the US Treasury repurchase market, and it's produced by the Federal Reserve Bank of New York. So SOFR is considered more reliable since it's based on actual market trades rather than estimates. So how does this impact an adjustable rate mortgage? So this index is what is used to determine the new interest rate on an adjustable rate mortgage, on an ARM loan. So for example, if you have a 5-year ARM, adjustable rate mortgage, your interest rate is fixed for the first 5 years. The interest rate begins to adjust after that initial 5-year fixed period based on market activity. So this index is what is used to determine what that new rate will be. Lenders were required to begin originating loans using SOFR instead of LIBOR back in October as LIBOR is being phased out. Now, for someone who has experience with adjustable rate mortgages and has had these types of loans in the past, they may notice the difference during the adjustment period because with the old LIBOR index, the rate would adjust once a year during that adjustment period. But with SOFR, the rate will now adjust every 6 months during that adjustment period. And the last industry update we're sharing here is regarding closings. So we're actually going to flip here. So e-closings is an ongoing change across the industry. There's a huge opportunity to streamline the closing process, which traditionally can be somewhat tedious and time consuming. The COVID pandemic actually helped to advance e-closings a bit as we all had to adapt to doing more business remotely and had to find alternatives to some of the traditional ways of doing things. So there's multiple benefits to e-closings. Obvious being that it's time saving and it's convenient. We have heard feedback of closing appointments being as quick as 10 minutes, where it used to be an hour. For relocating employees, especially e-closings can be convenient, especially if you have, for example, a spouses in 2 different locations. The relocating employee may already be in the new location while their spouse remains in the old location, maybe wrapping up their home sale. So with an e-closing, you could eliminate the need to, overnight packages back and forth or arrange for a power of attorney to obtain signatures. Now, what you see here is a very high-level overview of some of the different types of closings. There's certainly more ways to conduct a closing than what you see here and some other combinations of these features, but this provides just a good basic general overview. So a traditional closing is probably what most of us are used to. You have a closing appointment that's scheduled. You meet in person with the title company or closing attorney, and all documents are paper, signed with wet ink, and notarized in the traditional way. Now, a hybrid e-closing is kind of the best of both worlds. So you've got some documents that are signed electronically, and then a handful of documents that still are signed in person with wet ink. So in this case, a buyer could electronically e-sign the majority of their loan documents at their own convenience on the day of closing, and then just meet with a notary to quickly sign, the deed, the mortgage, anything that needs to be notarized and recorded. Now, an online e-closing uses what's called remote online notarization. All documents are signed electronically, and the notary is actually notarizing the documents remotely. So it's all done by webcam. You set up a video, and you sign your paperwork with the notary that way. It's all online. Now, one quick note about remote online notarization is that it does vary by state. There's different legislation that needs to be passed in states to allow notaries to provide this service. However, as more states do get on board, it'll be more widely available. And this is really the way ultimately that the industry is heading. So we've covered some recent mortgage industry changes. Now we're going to share just a little bit about the state of the current housing market. So we'll start with inventory levels. Now what you see here is through January of 2021. Inventory levels in January hit record lows with a 1.9 month supply. And if you don't know what that means, it means that at the current sales pace, it would take 1.9 months to deplete the existing inventory. So to put that in perspective, a 6-month supply is considered a healthy, balanced market. Now, keep in mind that we already had low inventory levels for some time now prior to the pandemic. The pandemic just contributed to an already existing struggle with inventory. You had, virus fears, health concerns, stay-at-home orders, and just general overall uncertainty. So that meant that many sellers pulled their homes from the market last year, or would-be sellers decided against listing. Buyers pulled back as well, especially at the beginning of the pandemic for those same reasons. And you can see that kind of reflected in this graph here during March, April, and into May. But buyers started to increase their house hunting and purchase activity in the late spring, early summer, with some restrictions easing a bit. There was a lot of pre-pandemic pent-up demand, and on top of that, interest rates started to drop to record lows, which we'll get to that more in a minute here. But this encouraged buyers into the market. You also had millennials, many millennials who put off home buying, took the opportunity to enter the market. And then, of course, some pandemic related changes had people rethinking their homes and considering, more square footage, maybe a dedicated home office space, or just a move to a less populated area. Sellers, however, were still holding back, though, and hesitant to list. Of course, virus concerns made people leery about having strangers in their home for an open house, or inspectors or appraisers. Also, just uncertainty about whether they would be able to find a new home to buy kept people in place. And then, of course, interest rates were so low that many homeowners refinanced into a lower rate, kept their home, and did some home improvements and upgrades rather than moving. So you can see, the steady decline in inventory there as a result. Now, according to Realtor.com, there were about 207,000 fewer homes newly listed for sale in the first 2 months of this year of 2021, compared with the average for the same period over the last 4 years. So low inventory continues to be an ongoing concern. So now we're going to look at mortgage interest rate activity. So the graph on the left is 2020, and you can see, the spike in rates in March and April. That was at the beginning of the pandemic when there was just a lot of uncertainty and the markets and people freaking out a little bit. Now, if you recall, the Federal Reserve took some actions to support the economy. They cut their short-term benchmark rate to near zero and took some other actions around buying treasury bonds and mortgage-backed securities, pushing cash out into the market. So mortgage rates steadily declined throughout the year. So at the beginning of 2020, the 30-year fixed rate was 3.75%. By the end of 2020, it was 2.67%. Freddie Mac actually reported record low interest rates 16 times in 2020. So there were a lot of potential home buyers looking to take advantage of these low rates. As I already mentioned, a lot of existing homeowners were able to take advantage of the low rates as well and refinance their existing mortgages. So it was a record year for lenders. The Mortgage Bankers Association reported that 59% of mortgage volume during 2020 came from refinances. So now let's look at the graph on the right, which is 2021. So in January, the 30-year fixed rate was 2.65% and increased to 3.05%, and this was as of March 11th. So increasing concerns about inflation are causing mortgage rates to increase. There are signs of a rebounding economy and improving economic outlook. You had the passage of the latest government stimulus plan. More people are getting vaccinated. Restrictions are easing, things are opening back up, and we're entering into the warmer summer months. So we could see people rushing out to eat at restaurants and travel and spend their money doing all of those things that they haven't done for a year. So there's some concern about this causing a spike in prices and some worry that inflation could force the Fed to raise interest rates and taper their bond purchases sooner than expected. Now, the Mortgage Bankers Association has forecast that rates will be around 3.5% by the end of this year. But one thing to remember is even with this increase, mortgage rates are still very low by historical standards, even if they do go, or even if they are above 3%. Okay, so we've got low inventory levels and record low mortgage interest rates. Both have contributed to record high increases in home prices. Now, according to FHFA, home prices increased 10.8% year over year in the fourth quarter of 2020, which is the largest annual increase in the history of their home price index report. Great for sellers. According to Redfin, asking prices hit an all-time high in January, and also recently reported that approximately 36% of homes sold last month went above asking price, which is the largest share on record. Not so great, however, for buyers who are facing an incredibly competitive market, bidding wars, competing against multiple offers or cash offers, not to mention affordability concerns as prices continue to rise. The median existing home price rose to $3,039 in January, which was up a little over 14% from a year ago. This is per Realtor.com. And you can see here on this graph, the median price in January 2017 was around $230,000. So it's a pretty significant increase over the last few years. And then again, here's just another visual. This is the median sales price. This is data from the National Association of Realtors. And you can see here the jump up from 2019 to 2020. So now, we're entering the typically busy spring housing market, and it's looking to be extremely competitive still as home prices are expected to continue to rise. Okay, so now that we've covered the state of the current housing market, we want to talk about what it's like for a buyer in this environment and some of the struggles and unique challenges a buyer faces, not only in finding a home to buy, but also in obtaining financing. So to kick off this next section, we've got a polling question here, which is, my transferees are prepared to buy and sell in this environment. So when you're answering this question, think about your employees, your transferees, or your customers, and some of the struggles that they might be experiencing, maybe based on some of the feedback that you're hearing. Now, while you answer this question, I'm going to turn it over to Ernie Phillips. Ernie is going to walk us through what it's like for a buyer trying to purchase and obtain financing in this environment.
Well, thanks, Cheryl. Just want to reiterate what Cheryl said at the beginning, and just thanking everybody for taking time out of your day to join us with our current updates and what's going on with the mortgage environment. We are going to leave the polling questions up just for a minute or so to give you guys a chance to answer those. You can, minimize that or drag it to the side if it'll help you see some of the screens that we go through. But as we go through this next part, when we're done with this next screen, then we'll revisit these answers to the polling questions for you. So as Cheryl mentioned, we're at record low inventory levels. So what does that mean? It means anyone who's a buyer is now purchasing in a competitive market. So what kind of advice would a lender be giving to those people looking to buy right now in this type of market? So typically when it comes to a buyer standpoint, get pre-approved early. Why would someone need to get pre-approved early? If you can go through an early credit pull, this will help you uncover something you may not know about. And it'll also give you time to fix it. So there could be something on your credit report that maybe doesn't actually prevent you from purchasing, but it could be currently affecting your credit score, which thus could affect your interest rate. So looking at that early is going to give you time to maybe call on that, get that corrected before you're needing to actually pull the trigger on a home purchase contract. And what does it take to purchase? Do I need to sell first? So visiting with your mortgage loan officer, going through the pre-approval, do I need to sell so I know more about the timing? Or can I qualify without selling, and maybe I'm going to tap into some of my other assets for down payment. Many lenders today are also offering verified letters. So if you go through the pre-approval early, you can be sending in pay stubs or bank statements, W-2s. Underwriting teams will take a look at that and then typically offer a stronger letter that says, hey, this person went the extra step. This person sent in documentation and are now have verified income, assets, and credit. So when a seller sees similar offers come through, which one do we think that they'd be more likely to take? Someone who said, hey, I went through an I-line application, or I just went through some verbal information, or I've had some things checked and I verified my income, assets, and credit. Typically going to be stronger and put a buyer in a better position when it comes time to place their offer. Also is going to allow you to actually house hunt when you're ready. If you're speaking with any agents, speaking with the realtors, typically that's one of the first questions that they're going to want to know, right? Have you been pre-approved? So am I taking you shopping in the right price range? Making sure that they're not, spinning their wheels, showing some homes if someone is not in a position to spend that or not in a position to get a loan when it comes time for them to actually put in the contract. Working with companies' preferred realtors. Why would that matter? Well, typically company preferred realtors, when it comes to relocation, they know about relocation. They know that there's typically some relo paperwork or addendums that go along with the contract. So they're going to have those ready. They're going to submit them at offer time and not have to scramble later and kind of add some paperwork at the end. They're going to have the buyer prepared early in that first offer situation. They typically know that some people get some home purchase benefits. So maybe they'd be asking those questions that maybe someone else may not ask. Therefore, they know that they don't need any seller concessions. They don't need to go in and put that as part of the contract, which if they're not asking for a seller concession, not asking for money from the buyer, from the actual seller, then that puts them in a better position as far as offering on that property. Being prepared to move quickly. So when it is a seller's market, there may be multiple offers coming in. So be ready to offer on that property that you want when you see it. If not, it could be gone later that day, later in that week. Be ready to negotiate and understand concessions that may be necessary. So what does that mean? Know that you're probably going to get a counter, and are you prepared to pay more than your initial offer? And when your offer is finally accepted, Cheryl mentioned before, a lot of them are going over list price. Are you prepared to potentially spend more for that property? Also, if you're going above list price, what happens if the house doesn't appraise? So right now, appraisers, they do look back at what has sold over the previous few months. So sometimes when prices are rising, it is a seller's market. The appraised values don't always catch up to what had sold 2, 3, even 6 months ago. And some of those appraisals may come in short. So are you prepared for that? What would you want to do if that happens? Can you renegotiate? Can you renegotiate that price to meet that lower appraised value? In this kind of market, the seller may not want to, but just know your options. Do you plan to pay the difference? Do you need to bring in a little bit more money for a down payment to make that loan scenario work, because you still definitely want to buy this house regardless of the appraised value? Or ultimately, do you want to walk away? If that appraisal came in shorter than your purchase price, do you maybe not want to purchase this house and then go back to house hunting? In concessions, what do we mean when we say concessions? Not like a seller concession asking for closing costs, but typically a house hunter is going to have a checklist or a punch list of desires that they want on this house. Do they want a corner lot or a certain lot size? They looking for an additional room, a sunroom, a deck, a 4th bedroom. All those things may not be available in this market on that house. And so are you willing to concede them? Do you really need that 4th bedroom, or is that something that you can say, I can do without, and so this is the type of property that I want to purchase. This is the one that I'm going to offer on. From an employer standpoint, partnering with lenders who understand relo. Typically, this is going to be good when the lenders know what to explain when it comes to documentation. For example, most lenders, most underwriters are going to look at when your home is selling, they're going to ask for the closing disclosure. Show me that CD, show me that closing disclosure so that we can know that that house is paid off and that debt can be eliminated from the picture. Also, if there's equity being used as a down payment, that's one way to document the assets. But when it comes to relocation, typically that borrower is not going to receive a CD. They're going to get an equity statement. So typically lenders making sure that their verbiage is matching up, saying make sure you get your equity statement from your home sale as opposed to trying to find a CD that you may never have. Also, lump sums have been big in relocation. You know, someone's moving, employer is going to give them maybe a $10,000 lump sum. That will then appear in their bank statement, and underwriting is going to look at that and say, hey, there's a $10,000 influx into a bank account, and they're going to ask the question, where did this large deposit come from? So Fannie Mae and Freddie Mac try to guard against money laundering. They do have anti-money laundering policies, and it does say that if there is a deposit into a bank account that is at least equal to 50% of their monthly income, they're going to be asked to paper trail that or source that large deposit. So if someone makes $10,000 a month, anything over $5,000 that is a deposit into their account is going to need some paperwork behind it. So knowing relo and knowing that someone has a lump sum, someone has this $10,000 expense, as opposed to saying, hey, go paper trail that for me, typically they're going to know that that's an expense reimbursement. So talk to your relo team. Maybe you already have an expense reimbursement form, but sending in that expense reimbursement form to match up how much money you got from the employer versus what was deposited into your bank is a way to document that and a way to tell the story that this isn't a cash deposit. It is a benefit that came from the relocation. How about for employers? Do they need to extend any benefits? You know, is it taking longer to find the right home? So if they have home purchase benefits, are they asking those to be extended? If so, for how long? How long are they willing to be extended while they're giving the transferee more time to find a house? While that's also going on, do they have temp living? Does temp living need extended, or does household goods storage need to be extended? Just being prepared for requests around benefits potentially needed extended while some of these house hunting are taking longer than typical time frames. So before we get into the next one, Allison, if you would share some of those polling results that we had. So look here, we got 5% said no, they're not prepared. 52% said somewhat prepared. 16% says that their people are well prepared, and then another 28, they do not manage relocating employees. So appreciate everyone's time taking to answer that. And hopefully some of these things that we just went over and will continue to go over may help some of those people who are either not prepared or somewhat prepared to shed some light and maybe give some answers on some of those. Okay, so what does it take to qualify in today's environment? Looking at the top right here, there has been an increased trend in remote work. And what does that mean when you're trying to document a file for mortgage purposes? Give you an example of, we saw initial relo paperwork, initial relo documentation, moving someone to Texas. Now this relo took a little longer based on what happened last year, but when it came time to purchase, family was actually back in Oregon, and a transferee decided that, you know what, they'd rather purchase in Oregon, but everything said they moved to Texas. So typically a lender's going to look at that and say, well, if your job's in Texas and you're supposed to be moving to Texas, a home in Oregon is not going to be your primary residence. It's going to probably be a second home or an investment property, and may carry just kind of different underwriting or different interest rates when it comes to those. But they were told now they can work wherever and still do that job. So from a documentation standpoint, transferee may come back to their employer and say, do you have a letter for me that says, hey, I can work remotely, or I can do my job wherever I'm located. Doesn't matter if it's Texas or Oregon or any other state. And with this remote work, my income's not going to be impacted. So that will help in the documentation standpoint. Same thing with a spouse who, may be moving, but they can work remotely now. Typically, they're going to ask for a letter to say that their income is not impacted for this move. They can do the same type of work in Oregon, or that there is no change to their income wherever they do actually reside. Reduction in pay, reduction in hours, and furloughs. So this was a bigger issue that we saw in 2020. We would see that people took a reduction of pay of maybe 10%, or their hours were cut based on what was going on with COVID, or they were furloughed a couple, 3 weeks, 2 weeks, somewhere in there, just to help with what was going on in the current market. So when you go through an application with someone, you ask what their base salary is, they give you that number, but then when you start to document this via pay stubs with reductions in hours or furloughs, it was coming out to be less than they initially told you. So what happened? You basically had to use that lower number because that was the pay then and there due to some of those reductions. So if they did qualify, that was fine. You just had to use those new numbers. If not, you may have to do some reworking of the loan, increasing down payments because their actual qualifying income was affected by these. Haven't seen as much of that in 2021. And so if these things were in the past and most of this reduction in pay and hours and furloughs have been restored and you're back to the original salary you were, then that current salary is what gets used from the qualifying standpoint. Bonus. When it comes to bonus, we did see that some bonuses were decreased in 2020. Some bonuses also were completely eliminated in 2020. Now, Fannie Mae and Freddie Mac looks at the past 2 years of bonus history. Typically, we'll take an average of the last 2 years. So if that bonus was reduced, well, that 2-year average is probably going to be a lower number than they were used to. And that average and that lower number for bonus is what would be used from a qualifying standpoint. Or if there was that gap, there was that 2020 that bonuses did not get paid out, that would be a break in that 2-year history, and it could affect being able to use bonus at all when it comes to qualifying. Forbearance. Forbearance has been in the news, has been in some bills. So we're going to look at kind of what that has been. So the COVID hardship forbearance was designed to allow for a pause in making current mortgage payments if you were affected by COVID. Your employment was affected by COVID. So the benefit is that lenders were not going to mark anyone late. They were not going to negatively impact their credit scores. Initially, when it came out, it was for 180 days, but then it would allow a request up to 360 days. We continue to see this get updated and bills get passed so that even now, if they're up against their 360 days, they can still even request another 3 months of extensions to not have to be marked late and not have to actually make mortgage payments while they're affected by this COVID hardship. I took a look at Black Knight, who is a mortgage data solutions company, and they estimate that about 2.6 to 2.7 million homeowners currently have their mortgage in forbearance. And of that number, about 1.1 million is set to expire at the end of March. So what are those 1.1 million going to do? This is going to be a good predictor of kind of where this economy is headed. Are they coming out and they are just going to continue to make their mortgage payments? They're going to start making them again, and positive signs because they can afford to now make their mortgage payments. Or are they requesting this extension, and so that 2.7 million may be growing or staying the same from the people who are currently in the forbearance program? Also, there is that foreclosure moratorium. So currently through June 30th, if you've not been able to make your mortgage payments due to this, lenders are not able to foreclose. That is set to expire on June 30th, but we continue to watch to see if anything will change with those dates. But again, just meant to help homeowners that they're not being foreclosed upon, and it's not going to affect their credit and credit scores and their qualifying when it comes to a new loan. So we took a look at Fannie Mae and to see what are guidance are they giving when it comes to loans that may be in forbearance? So I'm going to read to you a couple Fannie Mae FAQs when it comes to forbearance and then talk about what that actually means. So if the borrowers entered into a repayment plan to resolve missing payments during a forbearance, must it be completed before they are eligible to purchase or refinance? So the short answer is no. But if the borrower has entered into a repayment plan to resolve missed payments, they're eligible for a new loan after making 3 timely payments. So if they're in forbearance, they have to have made 3 timely payments in order to qualify for a new loan. But alternatively, if the repayment plan is completed in fewer than 3 payments, then they're also eligible. So how could it be completed in fewer 3 payments? I mean, they can make up the whole amount that is passed. And one way that we've seen people do that is, hey, they're going to sell before they buy. So by selling, they're going to catch up all those past payments and just pay that out via the equity that they have. And so what responsibility does the lender have if the borrower was entered into forbearance on an existing mortgage loan after they applied for a new loan? Again, following the guidance from above, but what happens is in the beginning, credit reports are checked and it shows maybe someone's not in forbearance, but it is also the lender's job that they will typically, check that credit report after they've been in process with them, typically within a week or so before the new loan has closed. And so if it was not seen in the beginning, but it is found out later on, again, they have to follow the same rules above and see, did they make 3 timely payments, or if not, are they going to sell and make this whole, or just bring that up to current? If that's the case, then they are eligible for this new loan, even while being in forbearance or catching that up. Okay, so we talked a little bit before about mortgage rates, where they're headed, where they've been, and again, just to reiterate, is Mortgage Bankers Association is predicting a rise in rates. They are expecting them to be closer to 3.5 by the end of this year. So where are they headed? Where have they been? Around this time last year, they were 3.65 compared to about 3.09 as of last week. So about 0.5% better last year than they are today. And also looking at a rise expected to go up probably about another 0.5% from where they are today between now and the end of the year. So based on that, interest rates changing, interest rates expected to rise, what does that have to do with affordability? So for every 0.25 or every 0.25% in interest rate change, it is going to affect someone's purchasing power by about $10,000. So if we're looking at today being right around about 3%, someone can take out a $320,000 loan with a $1,349 principal and interest payment. Now that same payment, if this rate continues to go up and goes up to about 3.5%, that same payment's only going to buy $300,000 worth of loan. So every 0.5%, if we're looking at maybe this jumping at 0.5% or so, you're going to see that affect purchasing power by about $20,000. So what are we going to try and watch for in 2021? These are kind of the handful of things that we will be watching and looking for. So rates, we talked about the prediction for them to rise, and that will ultimately affect someone's qualification and how much they can qualify for. Prices are expected to rise as well. They've been continuing to rise. And as again, rates rise, home prices rise, how does that affect affordability? How does it affect someone's ability to qualify? The vaccine, been so far successful rollout. If that continues to be a successful rollout, typically that means optimism for the economy. Anytime there's economic optimism, that's typically going to result in higher interest rates or push interest rates higher. The Fed actions. So what is the Fed doing? Currently, they said they're going to hold pat, but we will always continue to watch what the Fed does, what the Fed says, because whatever they decide to do, hold pat, if they decide to change due to inflation, that will definitely affect the market. That will definitely affect what rates will end up doing. And inflation, Cheryl mentioned kind of that pent up savings. If people do rush to make more purchases and spend more money stimulating the economy, again, if that happens, you're going to see some interest rates rise because, again, positive news for the economy equates to things increasing from an interest rate standpoint. So again, just a few things that we will be keeping our eye on for the rest of this year and see how that affects interest rates, how that affects qualifying, how that affects anyone looking to buy in 2021. So before we get into some of the Q&A, we did have one last polling question that we wanted to ask if everybody could complete, and just tell us what you thought of today. Did you find the webinar valuable today? Yes, it was very valuable, or it was just valuable, somewhat valuable, or not really not valuable at all. So if we could give a minute or so to answer some of those, just so we can have some of that feedback. And then at that point, we'll move into some Q&A so we can get some of those questions answered for you guys.
Great. Thank you, Cheryl and Ernie, for an excellent presentation. Just as a reminder, the Q&A button is located on the bottom of your screen in that little menu area. You can click on it and type your question directly into that area to submit a question. We already have a few questions, so why don't we go ahead and get started on that while you all are working on the polling. Let's see. Is there an accessible list of high cost areas so we can inform our customers?
So
Yeah.
there is.
Oh.
Go ahead, Cheryl.
Oh, I was just gonna, actually there is, like Ernie said, if you go to the FHFA website, I believe it's just fhfa.gov, they actually have an interactive map on there that you can look at the specific county to determine what the loan limit is in that county. So yes, absolutely, good question.
Great. It's what it says. When will these transition of the rates begin happening to every 6 months versus 12 months?
So that's okay. So I'm guessing this is regarding the transition from LIBOR to SOFR that we talked about at the beginning. So it's actually already in process. Any new adjustable rate loans that are being originated at this time are already using the new index. They're already being originated with SOFR. Now, and lenders were required to start originating new loans with the new exit or index at the end of last year. Now, if you have an existing adjustable loan, you should be notified by your lender of the timing of this change. LIBOR was originally supposed to be phased out towards the end of this year. The timing of things got a little bit messed up because of the pandemic. But you should, if you haven't received notification from your lender already, you should receive it this year. And keep in mind too that it depends on the type of adjustable loan that you have. So if you have, a 5-year ARM, your rate is still going to be fixed for the first 5 years, and this rate adjustment isn't going to mean anything until that initial 5-year fixed period is over.
Yes, and anytime you hold an ARM, the servicer does notify the borrower of when things are changing and how that's going to affect their new rate. So typically they're going to get that letter in the mail and how certain things affect their current loan when it is adjusting, what that new adjustment will look like. So that would be same, and just kind of identifying that it is tied to the SOFR index and what that is currently at to determine what your new rate would be during that adjustment period on the ARM.
Okay, great. Let's see. Are you seeing more lenders accept online closings signed via remote online notarization? Are you seeing that more and more?
Yeah, so this is definitely, the way that the industry is going. We have to, kind of remember that it's still an ongoing evolution of this process. There's still some state restrictions regarding, the licensing of the notary in that state, and whether or not the state allows the remote online notaries. The county that the property is in has to accept e-recordings, which a lot do, but there are still some counties that don't. The lender has to accept an e-note, but again, this is the way that everybody's heading, so it's only going to become more widely available as we move forward.
Okay, great. How soon can an employee refinance after being on forbearance?
So, as long as that has been caught up. So if they come out of forbearance and they're doing, 3 payments, they would have to make 3 payments out of forbearance in order to qualify for the new loan or catch up however many of those were in forbearance. If it was 6, 8, however long they were in it, either catch up all of those or, make 3 timely payments, and then they could refinance that current loan. Typically in a refinance, it's going to be looking at making those three payments once they came out of forbearance.
Okay, great. Well, kind of on that same thread, as we come out of this, do you anticipate we're going to see a high number of foreclosures as a result of, kind of this backup in payments?
That's going to be interesting because, the programs that were put in place because of the CARES Act last year, allowed for this temporary moratorium. There's been some, extensions added to that as well. But yeah, I mean, great question, because what's going to happen if the foreclosure moratorium ends? There are no more exceptions or extensions to that, and those individuals, maybe still have not gotten back on their feet, or still have not gotten into a situation where they can pick back up on their payments. So that's a really good question. I don't know that we have a firm answer on that.
Yeah, that'll remains to be seen, I guess.
Yeah.
So we'll have to kind of ride that one out. Let's see. Let's try to see some of these questions. Are you counseling the buyers on this if the home does not appraise? I'm not sure what on this means.
Well, I just, say from the standpoint of, what are your options? Whether we're in this market or any other market, if a house doesn't appraise, what are your
Okay.
options? Do you want to renegotiate with that seller to see if they would come down to match that price that's on the appraisal or that value that's on the appraisal? That's kind of the first option. But in this market, when they know there's probably another buyer behind you that were willing to maybe pay that price, they may not be as willing to renegotiate, but that's always, one option. Another option is, what does your loan scenario look like? How much were you putting down? Do you want to put more down, or change the structure of your loan and still buy this house that it came in or appraised for less than purchase price? So typically it's renegotiate, it's restructure your loan if you have the ability to, or it's, hey, I don't have either of those options. Is this maybe not the right house for me? And then you get out of that contract and you're back to look at it at a different property.
Okay, great. With this, kind of, it's sort of been a crazy market out there. Are you still seeing seller concessions for repairs identified during home inspections?
Not, I would say there's less seller concessions going on right now for anything, whether it is just price, whether it is for repairs, whether it is for closing costs. Currently, if there is, they're going to try and increase that price to cover some of those, because, like I said, they're expecting another buyer behind. Maybe when that offer was made, that there was multiple offers, so they know that there is much interest in their house with low inventory levels. So those concessions are definitely less today, just based on low inventory and more buyers that, if you want more concessions, or if you're not liking this, they're a little less apt to negotiate with you versus saying, I know that someone else is willing to, buy my house, so maybe I'll just go talk to them.
Okay. So we'll end with the question of all questions. With low inventory and increasing home prices, with buyers getting outbid, will the bubble pop? Any indications or thoughts on that as you gaze into your crystal ball?
I think, people compare to what happened, previously when the housing market bubble popped. And one thing to keep in mind is that we're in a different situation this time. As the result of the last, housing crisis, there were stricter guidelines put in place around appraisals and credit. So borrowers are a little bit stronger than they were the last time. I mean, you remember you had those loans the last time that were interest only, or you didn't verify income or assets. Those types of things aren't happening anymore. So people are in a stronger financial situation this time around. So it's a little bit different. I don't know, Ernie, if you have anything to add to that.
Yeah, I mean, when you look at a bubble and you look at just what Cheryl said, it is a different environment, but at some point, prices do level off. So yeah, they're in a rising rate environment, but we're not also in the spring buying season just yet. You're probably going to see the inventory levels change a little bit here in the next few months, and being more options out there on the market if people are deciding to list at some point. People aren't going to be willing to just pay top dollar for something that may not be worth it. So at some point, I do think that prices will level off, but we're just not there quite yet.
Okay, great. Thank you all so much for sharing your insights with us today. I know that there are some questions that we just couldn't get to today, but I will be saving those and sending them off to our speakers to take a look at. I want to thank you again, Cheryl and Ernie, and a very special thank you to Serva for their sponsorship of this webinar. You all have been a wonderful audience, and I hope you've enjoyed the program. Just a quick reminder to keep your eye on the Worldwide ERC website. We're constantly adding new events, and definitely watch your email tomorrow for a link to the course evaluation and to the page where you can access the handout and recording of this session. So thank you all again. I hope you all have a great day and a great weekend, and you may now disconnect.
Thank you.